A covered call is a staple option strategy, but I actually have a variation that you might be interested in because it completely overcomes one of the most common problems with the covered call option strategy. So, what's up, everybody? Eric here from ES Invests. Let's dive into exactly what this looks like. And as with every video, before we get started, I am not a financial advisor, nor am I affiliated with Barchart. I enjoy making content with my friends over there and sharing information so that other people can build their toolkit out. So that's all this is. It's information for you guys. All right, let's start off with what a covered call looks like, and then we'll get a little further into detail on this other approach called a ratio covered call. Okay. A covered call is typically pretty simple. You can see behind my head here, if we buy 100 shares of SPY, the S&P 500 index ETF, this is what your risk profile looks like. And this just helps us see how a structure behaves as an underlying moves around. So on your y-axis here, you have your P&L. So this is your zero line here. If it's above, we're making money. If it's below, we're losing money. And then your x-axis is just the price of the underlying. So right here is when I took this screenshot where SPY was trading. So as SPY goes up, this is where you go. And as SPY goes down, this is where the P&L will go. So the very first leg to a covered call, it starts with at least 100 shares of the underlying. Why at least 100? Because the other part of a covered call is when we add short calls against our long calls. Now, quick recap if you're not familiar with these concepts. Long shares, pretty straightforward. It's when you buy the underlying. Short calls is when you are collecting a credit up front, and your part of this call obligation, being short that call, means that you are allowing somebody to buy the underlying from you at a set price. And each options contract works in 100 share lots. So that's why you need at least 100 in order to cover the calls. So in this case, let's take a look. We buy 100 shares of SPY, and then we sell one call against it. Now you have a covered call. Notice what it did to your P&L. If we're just long shares, you have unlimited upside and then unlimited downside down to zero. When you sell the call, you're again agreeing to somebody to say, I will sell it to you at a set price. It's called a strike price. So as soon as the underlying trades above the strike price, your profit potential is capped, because you're telling them, I will sell it to you at this other price. So in this case, we're looking at buying SPY when it was trading at 523, and we're selling a 533 call against it. So that means we bought it at 523, we're willing to sell it at 533, and in order for this to work out, we're collecting money up front. We're getting a $2.93 credit, which is $293. So what happens in this scenario, though, is your upside is capped. That's actually kind of an issue, which we'll get into in just a second. So when we think about the pros and cons of a covered call, this is really a standard staple structure for most people that are familiar with options. And it's good for a lot of stock traders because if you're long shares, sometimes you can sell options against your shares, make a little more money in case it's not moving parabolically up or in case it's trending even sideways. So what you'll notice is it gives you an opportunity to profit a little bit if the underlying doesn't move at all. So for example, in this case, if SPY stayed right there at 523, you would make this $293, whereas you wouldn't have made that if you didn't sell the call. And that's one of the great parts about it. However, you will notice that you cap your upside potential, and that can be a problem, a big problem, especially if you're trading something like NVIDIA, where with this parabolic move up, if you're capping your upside, you're actually missing out on a lot of profit potential. So this is where we introduce this alternate structure, which is called a ratio covered call. Now, you might be able to guess where I'm going with this. It starts off this same setup. We're going to be long at least 100 shares. Notice the difference here. We need to have more than 100 shares. It can be 101 shares, 125 shares, 150 shares, 300 shares. It can be whatever you want. But what needs to happen is we have to have shares that are uncovered by the short call that we overlay. And notice what it does. In this scenario, I'm showing you where we're long 200 shares of SPY, but we're only selling one call against our shares. So what this does is it gives us a little bit of money up front. We get that $293 still, but we're not capping our upside potential. This is a really slick way to collect a little bit of money because who knows what the future has for us. Now, to be clear, if you're super bullish, I wouldn't trade covered calls. I would want the upside potential. But if you have a really long-term thematic position that is slowly moving up, it does offer an opportunity to be a little more efficient with our money. But if you still want to make sure that you're able to capture this upside potential, you can sell less calls than shares that you have. So again, remember, each one lot is worth 100 shares. So in this case, we have long 200 shares, but we're only short 100 shares against it via the short calls. This is exactly why this up here continues to trend upwards. So when we think about the pros and cons of a standard covered call to a ratio covered call, it pretty much all looks the same. There's very little difference. The only difference is we're not capping our upside anymore. You still get a little bit of downside protection. It's not much. A lot of people will talk about covered calls, hedging them to the downside. I actually think it's more of a mistake than anything, because if this moves to the downside, you're only collecting $293 against your $52,000 position. Not really going to help you quite that much. It's better than nothing, but that's not what I would hang my hat on in terms of why this position makes sense. You still have an opportunity to collect the dividend just like you did before. You still have that unlimited downside risk until it gets to zero. So all of the profile is just about the same. The only difference is we're making an upfront sacrifice. Because let's take a look at an example. Here we have SPY again, and now this is updated to current prices. So SPY is at 520 and the 533 call is at $2.30. So slightly different numbers, but the concept remains exactly the same. In this scenario, we're pretending that we're starting with at least 200 shares. And again, we could even change this. We could say that we have 150 shares. You don't have to have perfect 100 lot increments. You can absolutely, as long as it's more than 100 shares. So in this case, let's say that you have your long 150 shares. If we have a scenario where you sell this call, again, you now have unlimited upside potential. You want to create this ratio. Now, the reason why I use 200 shares is because it gives us a better comparison between ratio and not. So I want to start here. Because in this case, if you have 200 shares, you can sell 2 short calls against your shares to cover them, or we can sell just 1, which is where the ratio starts to kick in. So how do we decide? Do we want a ratio? Do we not? Well, it's actually a pretty simple decision. The first thing is, do you want to keep your shares or not? If you want to keep some of your shares, then that tells you we go to a ratio. If you want to offload your inventory, meaning sell your shares at a price that you would be happy at, then cover them. Have a 1-to-1 ratio so that this way, if SPY gives you your move and it's above your short strike price, then you get to offload your shares there at whatever profit that is. Now, if you're trying to optimize for profitability, there's a critical point we need to pay attention to. So let's figure out what that is. In this scenario, if we have 200 shares of SPY at 520 and we sell 2 calls against it, they're the 533 calls in this example, our max profit is $2,882. That's the most money you can make, because at some point, as soon as the underlying is trading above your short call strike, you are going to make the difference between your basis, which in this case is 520. So you'll make the difference between 520 and 533. That's your capital gains. And then you'll collect this full credit of 230, and you have 2 of them. That's your max profit. That's how you get to this. That's why it's flat. So you can make 28.82. So now if we sell it instead at a ratio, we need to figure out where that 28.82 occurs, which in this case, it's right about here at 540. So what this means is with SPY trading right now at 520, up until $540, you would make more money if you sell it at a 1-to-1 ratio. Above that point is where having the ratio makes more sense. So what does this mean? Well, if you're really bullish in something, you don't want to cap your upside. If we're expecting a big upside move, we want to allow ourselves to appreciate as much of that move as possible. If you have a more conservative estimate in terms of where you think it might go, then you can say, yeah, okay, well, I actually don't think it's going to fly above 540. So I'm okay selling at a 1-to-1 and collecting an additional $230 upfront instead of just on a one lot. The name of the game here is using options as a strategic investment to fit your specific needs. If you need to offload inventory, 1-to-1 starts to look good. If you have a big directional assumption, but you're not sure when it's going to happen, or if you want to be able to make more money, uncapping your upside makes a lot of sense, but you need that accommodating move in order to get there. Now, one other thing I want to show you guys quickly. Barchart has this really cool covered call screener that you can use. You can set different filters so you can say exactly what you want to look at. And then again, if you want to trade them at a ratio, it just means you have to have more long shares than you do short calls. But you can find some great opportunities in here. As always, if you have any questions, let us know. Don't forget to like the video, subscribe. Let us know if we missed anything or what else you want to see next. Be an outlier. I'll see you guys later.